Did you know that your spending habits might change depending on who's in the White House? That's right. Elections don't just decide political futures, they can shift the entire landscape of consumer confidence and investment strategies. But how exactly do these elections affect your wallet? Well, buckle up because we're about to dive deep into the fascinating connection between US elections and your financial decisions. Stick around, because later in this video, we'll reveal surprising statistics that show just how much your financial choices are influenced by political climates. Plus, we'll share strategies to help you navigate this election year like a seasoned investor. First, let's define what we mean by consumer confidence. Simply put, it's how optimistic or pessimistic consumers feel about the economy. According to the Conference Board, consumer confidence tends to rise before elections and often dips afterward, especially if results are uncertain. This psychological phenomenon is crucial because when people feel confident, they're more likely to spend money, boosting the economy. Consumer confidence directly affects spending. When consumers believe the economy is strong, they splurge on everything from dining out to making big purchases like cars and homes. Conversely, if confidence falters, people tend to tighten their belts, opting for savings over spending. Now let's take a look back. Historically, consumer confidence has fluctuated with election outcomes. For instance, during the 2008 financial crisis, confidence plummeted, and spending dropped significantly as people feared job losses and economic instability. The uncertainty surrounding that election led to a notable slowdown in consumer spending. In fact, a study by the National Bureau of Economic Research found that consumer spending can decrease by as much as 5% in the months following a contentious election. This statistic illustrates how strongly elections can impact economic behavior. In an environment of uncertainty, consumers are often reluctant to make significant financial commitments. Fast forward to today, what's happening with consumer confidence in the current election cycle? According to a recent Gallup poll, only 38% of Americans are satisfied with the economy, which could influence their spending behavior dramatically. This dissatisfaction creates a ripple effect. When consumers feel uneasy, they often choose to save rather than spend. As political discussions heat up, issues like inflation, healthcare, and taxes dominate the conversation. Each candidate's stance can sway consumer sentiment, especially among those directly impacted by these policies. For example, if a candidate proposes significant tax increases, consumers might anticipate higher costs in the future and adjust their spending habits accordingly. The political climate can create a sense of urgency. When campaigns ramp up, particularly in battleground states, candidates often make promises that can have immediate effects on consumer behavior. For example, proposed stimulus packages or infrastructure spending can give consumers hope for better financial prospects, which may lead them to spend more. Consider the economic stimulus checks issued during the pandemic. These funds provided immediate relief, leading to a temporary surge in consumer spending. This scenario illustrates how government actions during election years can lead to significant shifts in consumer behavior. So how should investors respond to the election? Thrive or struggle based on election outcomes. For example, healthcare and renewable energy stocks often see a boost if candidates with favorable policies toward these sectors win. In contrast, traditional energy sectors might face declines if green policies take precedence. This pattern underscores the political trends. A study by Bloomberg suggests adjust their portfolios during election years, seeking to capitalize on these shifts. Investors often look for sectors that align with the anticipated policies of incoming administration. A candidate who prioritizes green energy is elected, companies in renewable energy could see significant gains. Conversely, fossil fuel companies might take a hit. But it's not just policies that matter. The media plays a significant role in shaping public perception. During election seasons, sensational headlines can create anxiety or euphoria among consumers, directly affecting spending habits. A survey by Pew Research found that 72% of Americans say they often hear conflicting news on major political issues, which can lead to confusion and distrust. Remember, misinformation can lead to irrational financial decisions. Always seek verified sources to inform your spending and investing choices. The digital age has made it easier than ever for misinformation to spread, so staying informed through credible outlets is crucial. Let's delve deeper into the psychological aspects. The uncertainty surrounding elections can create stress and anxiety, leading many consumers to adopt a wait-and-see approach. A study by the American Psychological Association found that political uncertainty can increase financial anxiety, which in turn impacts spending decisions. People may hold off on major purchases, fearing that their financial situation could worsen depending on the election outcome. This behavior not only affects individual finances but can also slow down overall economic growth. While the immediate effects of elections on spending and investment are significant, the long-term impacts can be equally profound. Policies enacted during one administration can have ripple effects for years to come. For example, tax cuts can lead to increased consumer spending in the short term, but long-term deficits might cause future administrations to implement tax increases, affecting spending power later on. Understanding these long-term implications can help consumers and investors make more informed decisions. It's essential to look beyond the immediate election outcomes and consider how these policies will shape the economy in the years ahead. In conclusion, U.S. elections do more than just decide leadership. They profoundly influence how you spend and invest your money. From consumer confidence to investment strategies, the effects are widespread. By staying informed and adaptable, you can make smarter financial decisions that align with the political climate. If you found this video helpful, don't forget to like, share, and subscribe for more insights on finance. We want to hear from you. How do you think the current election will affect your spending and investment behaviors? Drop your thoughts in the comments below.